I want to turn to our next guest, Ira Jersey. He's the director of U.S. interest rate strategy at Credit Suisse. And Ira, you and I have talked quite a bit about where rates are headed and where treasuries are. And you almost wonder. Months ago we had all these Chicken Littles out there talking about how the sky is falling, the economy is going into another slump, and you couldn't tell quite yet with the stock markets. But it looks as if through the bond markets now that the bond investors were right about this.
Well, I think in some ways you have to look at not only will we double dip. I think that's certainly the risk case, and that's one of the things that the bond market is trying to get ahead of, is saying, are we going to have very low inflation for a very extended period of time, if not outright deflation? So you have this one camp that's worried about longer term inflation, which would lead to potentially higher rates longer term, but near term you really don't see the kind of growth in inflation numbers that you need. And this morning's number is a perfect example of that. I mean, it was a very, very poor number and doesn't point to quickening growth at all. And in fact, will bring up additional double dip and deflation fears in a lot of sectors. So it's not surprising that we're seeing yields rally today.
Okay, but what part of the bond market looks most rational to you?
Well, the very front end looks the most rational, and in fact, we expect there to be a little bit more of a rally in twos, but there's not much more juice left to go. So we think that twos can trade down to 40 to 44 basis points. Right now, they're around 47, 48 basis points, and the reason for that is that the Federal Reserve being on hold for the next 2 years means that short end yields can continue to come down. Meanwhile, curves have to flatten in order to kind of absorb this excess demand for relatively safe assets. So that's one of the reasons why we like the 5-year sector, even though real yield terms it's basically at zero.
Wait, but I want to make sure I get this right. So you actually buy into the deflation on the shorter end, or the shorter term?
Well, not deflation, but if the Federal Reserve is going to keep short rates at 20, 25 basis points for the next 2 years, which is more or less our expectation, and also the Fed's own expectation, if you back into what they expect rates to be based on their own expectations that came out just a couple of weeks ago, then the 2-year is going to trade at funds, which is 20 basis points, plus some term risk premia, which is about 1 basis point a month. So when you sum all that together, you get 44 basis points. I
see. Okay. So Ira, are we we're so much focused on the negative side of this, but are we ignoring in some ways the positives? You've got record low rates. It means the U.S. can continue to fund its deficit at these low rates, and you've got corporate borrowing costs continuing to come down. Are we ignoring maybe some of the positives in this that could feed into the economy?
Well, I actually am of the belief that we are seeing some of the normal recovery items happen. So things like corporate investment is picking up, and but the thing is, it's happening at a snail's pace. What's going on today is going to take years, whereas it used to only take a few quarters in previous recessions. So I think part of the recovery process winds up being patience. What it does mean is that yields can remain reasonably low. It means that the back end at some point will probably stop coming in. So you're looking at like the 10-year, for example, probably won't get much flatter than 180 basis points compared to the 2-year. Okay. But just based on what we just said, that means that 10s could get down toward 220 in yield.
And when it all turns, Ira, is it going to be pretty quick when the tide turns?
Well, probably not. I think we'll see some warning signs of that in some of the economic reports. So, for example, increased payrolls, if nothing else, increased wages. I mean, those are the types of activities that wind up driving forward growth.
Ira, good conversation. Thank you so much for joining us.
Betty.
Appreciate it. Ira Jersey, the head of U.S. interest rate strategy at Credit Suisse.